afternoon, everyone. We're going to go ahead and get started today, and we are going to be talking about enhanced inventory receiving. We had left off with our webinar series last week discussing bill management and payments on the accounts receivable and customer side. We were going to work to push into the vendor side, but this actually creates a great segue for us to talk about inventory management and accounts payable, which ultimately leads us to how payments are handled on the vendor side. Okay, so getting into today's topic, we want to discuss what is enhanced inventory receiving, how does that differ from the standard inventory receiving process, what does it look like from a workflow standpoint when we make that change to use this feature, and what do we have to be mindful of that will change our workflow output. The first thing I want to discuss is how is QuickBooks normally handling inventory management versus what changes when we implement enhanced inventory receiving. In QuickBooks, the natural progression for inventory receiving is to go from a purchase order to an item receipt, and then that item receipt is ultimately replaced by a vendor bill when you are ready to submit payment. With enhanced inventory receiving, this feature works to keep those areas completely separate and independent of each other. It will include inventory management being handled solely by an item receipt and accounts payable or our vendor payables being handled solely by our bill entry. So that is going to be one of the main differences, is that these operations that typically go hand in hand will be completely separate. This is one of the key factors and usually deciding pros or cons, depending on how you look at it, that determine whether or not our clients will use this feature. One of the other popular reasons why our clients will decide to use enhanced inventory receiving is if they have any kind of prepaid inventory. Typically, there are two ways that prepaid inventory can be managed. First is through an asset account that shows we've created a payment to our vendor and are due to receive an inventory. The alternative, which is what we don't recommend and don't like to see happening, is entering that bill ahead of time in order to be able to create a payment. What that unfortunately will do is overstate our inventory and show that we've got items in stock when in actuality we haven't received them yet. With enhanced inventory receiving, because it allows us to keep the inventory management and accounts payable separate, we're able to show that we've made a payment up front without impacting our inventory. And this is something we'll take a look at, and you guys can see how exactly those two processes are kept separately. One of the last common reasons that our clients will look at using enhanced inventory receiving is because it allows you to bring in multiple item receipts, meaning we can receive in batches. Sometimes we don't get that inventory in all at once, and we're able to create multiple item receipts based off of when the products are actually received. With how QuickBooks normally handles inventory, every item receipt would ultimately become a bill that would need to be paid. However, in instances like this, all of those item receipts typically refer back to a single bill that needs to be paid in full, and using enhanced inventory receiving allows us to keep that combined information together rather than having to flow multiple item receipts through multiple vendor bills. It will also work in the opposite direction. Sometimes we do have instances where, because we are receiving our inventory in batches, we do have multiple vendor bills that ultimately point back to a single item receipt. So we have the capability to make sure that however many instances of inventory are received, we're able to line that up appropriately with the bills or invoices we are receiving from our vendors. How to enable and use enhanced inventory receiving. I'm going to come in here and we are going to look at where we turn on this preference. We want to understand what it means when we turn on this preference, and then how does that impact us when we're going through our actual receiving process. If we come in here to our Edit tab and to Preferences, under our Items and Inventory section and Company Preferences, you can see here I have Enhanced Inventory Receiving, and my QuickBooks file says that this feature is enabled. When you go to turn on this feature, QuickBooks will give you a warning that lets you know once this feature is enabled, you cannot disable it. The plus side to that is that QuickBooks will allow you to create a backup copy of the file prior to turning this on, so that if for whatever reason there are issues with the file or that functionality is not something we need, we always have a backup copy to revert to. This is typically our recommendation in order to allow our customers a test opportunity. We want to use that backup copy to go through and review how this feature is used before we implement in a live system, just to avoid any kind of issues with not being able to disable or turn off this preference. Once we've got this feature enabled, QuickBooks will automatically create what's called an inventory offset account. This shows as an other current liability. The way that this account is used is now that our inventory management or receiving is separate from our vendor bill and accounts payable entry, this account will act as the offsetting account for each of those transactions. It essentially becomes a wash or pass-through account that we should always see work its way back down to zero. One of the helpful things we can do with this account is we can actually work to reconcile it to zero. And what that allows us to see is what items have been received versus what bills have been entered, to know which offsetting side is possibly not input in the system. So QuickBooks will automatically make sure that our item receipts and our bills flow through this account. There aren't any kind of journal entries or adjustments that need to be made. It will automatically push through this wash account so we can see what has been received in and what has been entered on the payable side. Next, before we get into what doesn't work with enhanced inventory receiving, I want to go ahead and take a look at what those actual entries look like now that enhanced inventory receiving is turned on, and what that reconciliation feature entails, so that we can easily track inventory as well as our accounts payable. Like I said before, it does not change the transaction types that we have available for our inventory management. We still have the opportunity under our vendors area to receive in items as well as enter in bills. Those functionalities will just now be independent. For example, in order to receive in inventory and update our quantities on hand, this function will now flow through an item receipt. If I look at our Reports tab and our Transaction Journal, you can see this shows me the background of that item receipt. One side of our transaction hits our installation inventory account, and one side hits our inventory offset account. These are going to be the debits and credits of this transaction. Similarly, when I look at my bill entry, before, my bill entry would work to hit two accounts. One side was accounts payable, one side was inventory asset. Now, with my transaction journal, I'll see that one side is still hitting my accounts payable, the other side is hitting this inventory offset account. So every time we have an item receipt that also has a corresponding bill in the system, we should always see those work its way down to 0 in our inventory offset account. When I come in here to my banking tab and I choose to reconcile that account, I can go ahead and choose my inventory offset account. And again, this account will not have a statement. It is one that should be reconciled to 0, and we should have offsetting transactions that will net. So I would put in my balance of 0 and continue. And QuickBooks will let me know, based off of the transactions listed, what I've received in, as well as what I've entered for a payable. If I don't have matching transactions on both sides, that lets me know that I'm missing a step in my inventory management process. So as you can see here, my credit side is going to be represented by my vendor or AP bills. My cash or debit side is going to be represented by my item receipts. And again, we like to relate that to inventory. When we bring inventory in, that is debiting our asset account and increasing that asset value when we bring product and material in. As you can see here, as an example, I've got 2 transactions for the same dollar value, plus an additional transaction for $6.15. What this is telling me is that I've received in a small amount of inventory for this dollar value, but I don't have a corresponding bill yet that shows that I've paid for this inventory. Vice versa, if I had an additional transaction on my right-hand side in my credit section, that would typically be an indicator that we've prepaid for some sort of inventory that we haven't actually received in yet. In order to make sure that we're reconciling this account to keep up with what steps on either side of the inventory management still need to happen, I would go ahead and check off my corresponding transactions, and then I would choose to reconcile. Once I do this reconciliation, anything that's still outstanding, aka uncleared, in this account will let me know what steps I still have to take in order to go ahead and either bring in my inventory or pay my accounts payable. From a reporting standpoint, enhanced inventory receiving does not change anything. The only difference is going to be that when you're looking at your item history, you will automatically see 2 transactions for every instance of that inventory being brought in. Again, going back to how QuickBooks normally handles inventory, we have our item receipt that allows you to input for quantity on hand, and then that item receipt transitions to a vendor bill when we are ready to make our payables. With enhanced inventory receiving, these functions will live separately, and we will always have double entry in the system. That can sometimes be a concern from an entry standpoint in QuickBooks, and that's always a great area to identify to see how is that going to impact the volume of information that's going into our system, and something to be mindful of when we're considering file size and our growth in QuickBooks. Coming in here to talk about the things that we would need to be mindful of when we're talking about what enhanced inventory receiving no longer allows us to do. These are some of the cons and pros we want to weigh when determining if we ultimately want to use this feature. The first thing is that you cannot add negative items to an item receipt or a bill to reduce down item quantity. Because the vendor bill no longer impacts our inventory quantities, we're not able to make an adjustment on that entry to change our quantity on hand. In addition, because that item receipt's sole function is now to bring in our inventory on hand, we can only input positive quantities. If we need to make any kind of adjustment to reduce down a quantity, we would have to do that through an inventory adjustment. The second thing is you're not able to add anything to the expenses tab on an item receipt. This has to be done at the vendor bill stage. If we come back here to our transaction entry and we look at our item receipt, you can see normally QuickBooks would have two tab options. One would say items, the other would say expenses, and you could toggle between the two to input whatever expense is happening for a vendor. With enhanced inventory receiving, the item receipt will only allow you to input item information. That expense information now lives on our vendor bill. As you can see here, we still have that expenses tab. The item tab will be to show the inventory that we're paying for. Our expenses tab, as an example, might be used for shipping and freight cost, customs, duties, things of that nature. So we still have the capability to apply those expenses. It just happens at the time of entering the vendor bill rather than being able to do it on an item receipt. In addition, you're not able to mark items as billable on an item receipt. This has to be done at the vendor bill stage as well. So again, if we look at our vendor bill, you can see on our items tab, we have this billable checkbox here. What this allows us to do is if we are inputting a customer that this particular product is for, we have the capability to check mark that it is billable, which allows us to automatically enter this again against a customer invoice at a later time. So when we are talking about whether or not we need to be able to direct bill back to our customers or our clients, that is ultimately going to be done at the bill stage. That functionality is no longer available at the item receipt. We do still have the option on the item receipt to note if this is for a particular customer. Sometimes our clients will use sites or jobs to track where a particular product is meant to go. So you do still have that allocation option. The only difference is being able to choose whether or not it's billable and needs to be directed to an invoice for that customer. The next thing is very important just because a lot of times we do have our clients who use purchase orders for both inventory and non-inventory information. So this receiving piece is particularly important to note when deciding whether or not we want to use this feature. If you have any kind of non-inventory items, and what I mean by that is some sort of product or material that we don't track a quantity on but still do a receiving of, QuickBooks will require you to input an item receipt in order for those items to be considered as received and for those to be closed out on the purchase order. One of the common questions that I get with our clients is, do we have the capability to choose what items we used enhanced inventory receiving for and what items we do the normal receiving process for? Unfortunately, once this feature is enabled, QuickBooks requires you to go through this process the same way for every purchase order or every item related entry. So that is very important to keep in mind when determining if we want to use this functionality. Again, going back to that big picture of double entry. We would always have an item receipt to bring in our inventory, or in this case, non-inventory, and a separate vendor bill to handle our accounts payable. This last one is actually a positive feature when talking about cost management of our item, especially if we have any kind of delays for when inventory is received. This usually coincides with that idea of prepayment of inventory if we've got long lead times for inventory getting into our hands, getting to our warehouse, particularly if we've got overseas vendors as an example. One of the pluses or benefits to using enhanced inventory receiving is that if the cost of an item on a bill is changed after that item receipt has already been created, QuickBooks will make that retroactive update so that the two amounts match. So sometimes if we've received in inventory but certain charges weren't accounted for, or there was a delay in getting the invoice, we had the wrong cost, possibly there could be a variety of reasons. QuickBooks will actually work to make sure that those two transactions match, which again, ultimately helps us when we're talking about doing that reconciliation to check on how we know what has been received in versus what we have to pay to our vendor still. So this is a positive to keep in mind when considering using enhanced inventory receiving. Coming back in here to recap ultimately what that enhanced inventory receiving feature does, it allows us to create separation of duties inside of the system. Naturally, QuickBooks will work through the progression of purchase order to item receipt, and then that item receipt will transition to a vendor bill when we're ready to pay our accounts payable. With enhanced inventory receiving, that item receipt for inventory quantity and that accounts payable for our vendor balances are maintained completely separate. This can be a positive, especially if we've got different team members functioning in QuickBooks who handle those duties. Sometimes that separation isn't as available with the normal process that QuickBooks does. So being able to use this feature and have those two steps be completely independent is helpful to ensure we've got the right team members doing the right entries inside of the system. When we're making those entries, everything is going to flow through that inventory offset account that QuickBooks will automatically create. There isn't a need to add a separate account. QuickBooks will automatically push through its default account, and we will see what is being done both at the item receipt level as well as the vendor and accounts payable level. When we look at our item receipts now will only impact our inventory quantity on hand. We can see that via that transaction journal in the background that shows inventory as well as that offset account being used. Similarly, with our vendor bills, we have the same impact but with accounts payable. One side hitting our accounts payable, the other side hitting that inventory offset. That allows us to check our account and go through those reconciliation steps to know what we are missing in regards to our inventory receiving process. From a reporting standpoint and inventory costing, it does not change that information. As we saw, one of the pros to using this feature is that QuickBooks will help perform management to make sure that the item cost, the items were received in at match the accounts payable vendor entries. You can see here though, from a reporting standpoint, that doesn't change what our valuation is or how QuickBooks manages the cost of our items. That asset value is still maintained the same way, and we see it reflected from a costing perspective when we invoice our customers. Final things to consider when determining if we want to implement use of this feature or not. First comes down to making sure we know this is a stuck feature. Once it's turned on, it can't be disabled unless we revert back to that previous copy. And then just understanding some of the things that now may have to be pushed to our vendor bills as an example, like our expenses or any kind of billable information. So slight change in process. However, those capabilities still are there. They're not completely gone. It's just a little bit of a different entry. The next thing that we'll talk about that piggybacks off of use of this enhanced inventory receiving and ultimately getting us to our accounts payable entry is management of payment with our vendors, as well as what our online or merchant payments are. Thank you guys very much.